Every December, the smartest, best-paid analysts on Wall Street publish a single number, where the S&P 500 will end next year. Here's the problem. Line up the last 16 of those predictions against what actually happened, and they missed 13 times. Not because these people are foolish, they're brilliant, but the thing they're selling, a confident single-number view of a chaotic future, may simply not exist. And the whole financial media runs on it, scary predictions, euphoric ones, all delivered with total confidence, all quietly shaping how you feel about your money. This isn't about finding a better crystal ball. It's about why the crystal ball is the wrong tool entirely, and what calm, long-term investors use instead. Obsess over prediction. That's the whole idea. A thinking skill, not a market call. None of this is buy or sell advice. Let's get into it. Start with the ritual nobody questions. Because if these are the best informed people alive, why do we keep believing one number about an unknowable year? Take this year. For 2026, the big bank's targets range from 7,100 at the low to 8,100 at the high, anywhere from a 3% gain to a 16% gain, all presented with equal confidence. Just what a single number quietly assumes. It assumes the year is smooth, a straight line to a destination. But markets don't move in straight lines. They move in shocks. And here's how unusual normal really is. Across 97 years of data, the number of times the S&P 500's annual return actually landed in the 8 to 10% average band? 0. Not once. Forget the average. Since 1926, stocks averaged about 10% a year, but they actually landed near that average in only 6 of 93 years. The typical year is almost never typical. Markets are lumpy, not average. Some years soar, some crash. Almost none are normal. So a forecast that quietly assumes a calm average year is mispriced before the year even begins. And there's a built-in bias. Over the last 25 years, the market fell in 7 of them, but Wall Street's consensus predicted a gain every single year. It has never once in a quarter century called a down year. So every January, the whole industry stakes its credibility on guessing a number that history says almost never even shows up. Opinions are cheap. So let's look at the receipts, the documented track record of professional market forecasts. Start with the headline number. Over the past 16 years, Wall Street strategists missed their year-end S&P target 13 times by about 10% on average. And it's not getting better. Over the last 4 years, the median forecast was off by an average of 16 percentage points. That's not a slightly imperfect tool. That's noise dressed up as signal. An asset manager graded 8 straight years of these forecasts. The number of years the consensus got within 10% of reality? Exactly 1. Look at how big the misses get. Going into 2024, the consensus expected about a 2% gain. The market returned about 23, a 21-point miss, in a single year. In 2008 was worse. Strategists predicted a 9% gain. The market fell 38, a 48-point miss. The year a single confident number turned into the worst crash in a lifetime. For a full 25 years, the average forecast missed the actual return by more than 14 percentage points a year. A coin flip on direction would have done about as well. A peer-reviewed study put it bluntly. These survey forecasts couldn't even beat a coin flip model that simply guessed last year's average. So why are the targets always so similar to each other? Not because the consensus is wise. Research on analysts shows that going against the herd and being wrong gets you fired. So everyone clusters near everyone else. It's career safety, not insight. And it's structural, not laziness. A simple economic model can predict about half of analysts' forecast errors in advance. The method itself is built to miss. Markets are just uniquely hard. So here's the unsettling part. This is a property of expert prediction itself. A psychologist named Philip Tetlock ran the definitive study. Over 20 years, he gathered 284 experts and more than 82,000 specific predictions about politics and economics. His verdict became famous. The average expert, he found, was about as accurate as a dart-throwing chimpanzee. 284 experts, 20 years, 82,000 forecasts, and the average expert barely beat random guessing and lost to simple statistical rules. The most useful finding was about who did better. It wasn't the most credentialed or the most ideological. It was a matter of temperament. Tetlock split them into 2 types. Hedgehogs know one big thing and force every event into it. Foxes know many small things, hold their views loosely and update often. The foxes won, consistently. And here's the twist that should make you change the channel. The single best predictor of being wrong was fame. The more famous the expert, the more they were on TV, the worse their forecasts. Think about that. The confident single narrative made for TV style, the exact style that gets booked and quoted, is the style that's most often wrong. Punchy in certain cells. It just doesn't predict. There's a hopeful flip side. In a US intelligence tournament, trained amateurs, super forecasters, beat professional analysts who had access to classified secrets by around 30%. The goal was never to find the rare genius forecaster. Once you see this, the question flips entirely. How do you invest without needing a forecast at all? The secret wasn't bolder calls. It was the opposite. Small, humble, frequent updates, thinking in probabilities, never in certainties. There's a deeper, almost mathematical reason a single year-end number is doomed. The future isn't a point, it's a fan of paths. The whole year usually hinges on a few unscheduled days. From 1900 to 2023, big 2.5% moves happened on just 3.5% of trading days. but they drove about a fifth of the market's entire movement, and the misses run both ways. Over 20 years, the start of year target was off from the actual close by about 6% on average. Too high in 11 years, too low in 9, never converging on the truth. And nobody schedules those days in January. The biggest movers are surprises. A policy shock, a war, a crisis, by definition absent from any year-ahead model. It's so unpredictable that even with next-day newspaper hindsight, about 1 in 10 of the largest market moves still has no identifiable cause at all. If we can't explain them the morning after, no one is forecasting them the year before. And the surprises often come from a podium, not a spreadsheet. News from the Fed and the government triggers more than twice as many giant up days as down days, moves no January model could schedule. Classic research agrees. Identifiable economic news explains less than a third of the market's moves. The rest is flows, shocks, and things we still can't name. Now stack a second problem on top. Even the market's long-run gains come from a tiny handful of winners. Over 90 years, only 43% of US stocks beat a treasury bill. The index's whole return is the tail, not the typical stock. And those winners are absurdly few. Out of nearly 26,000 US companies over 90 years, just 5 created about a tenth of all the stock market wealth. Miss those, and the market return was never yours. So a year-end target is a single-point estimate of a path-dependent, shock-driven winner-takes-most system. The honest output isn't a number, it's a wide range of outcomes with probabilities. But a range doesn't make a headline, so the media compresses a cloud of possibilities into one false confident number and hands it to you as if it were knowledge. So the year hangs on a few unscheduled days, a few unknowable shocks, and a few names nobody can pick in advance. A single number was never going to hold all that. So here's the calm alternative. How you invest when you accept you can't predict the year. The shift is simple. Stop forecasting the future. Build a process that survives all of them, and it starts by trading narratives for base rates. Here's the base rate that matters. Over the last 97 years, the US market finished positive in about 73% of them. You don't need to call the year to know the odds are deeply in your favor over time, and time does the heavy lifting. Across every rolling 20-year period since 1926, US stocks have never once lost money. Not through the Depression, not through world wars, 0 negative 20-year stretches. Stretch it to 30 years and even the worst possible start, buying right before the 1929 crash, still compounded at almost 8% a year. Time turns chaos into near certainty. So think in ranges, not points. Stay diversified. Update your views slowly. Avoid all-in conviction. That's the superforecaster's edge. Borrow the temperament, not the certainty. And whatever you do, don't try to time the exits. $10,000 left in the S&P from 1996 to 2025 grew to $192,000. Missed just the 10 best days, and you end with $85,000, 56% less. And you cannot dodge the bad days and keep the good ones, because they're tangled together. 76% of the market's best days happened during a bear market, or in the first 2 months of the recovery, right when forecasts told you to run. This is why reacting costs you. Over the last decade, the average fund returned about 7% a year, but the average investor in those funds earned only 6 by buying and selling at the wrong times. A point a year surrendered to emotion. And the calmest designs protected the most. Simple, automatic, diversified funds had almost no behavior gap. The exciting, concentrated sector funds had the worst. Emotion is most expensive where it's most tempting. Now the payoff for doing nothing clever. $10,000 left in the S&P from 1950 through 2025, through every crash, every scary forecast, every recession, grew to about 44 million. So the durable edge was never a better prediction. It was needing the prediction less. Treat the confident year-end calls, the scary ones and the euphoric ones, as entertainment to notice, not instructions to act on. The whole game was never to see the future coming. It was to build something that doesn't need to. None of this is financial advice. It's a way to think. Stay diversified, stay invested, and stop grading the future on a single number nobody can know. If this helped, follow Market Minute. I'll see you next time.